If you had given Warren Buffett $10,000 to invest when he started his career in 1956, your money would now be worth significantly more than $100 million. There's nothing exceptional you need to do if you want to invest like Warren Buffett. Here's a look into Buffett's simple investment approach that may motivate you to become rich. With billions worth of shares of his own Berkshire Hathaway, Buffett contributes significantly. Buffett, who is regarded as one of the greatest investors in the world, portrays himself as a simple man with a simple plan and has produced decades of financial returns that have impressed even the most astute Wall Street professionals. According to Warren Buffett, he would most likely spend his $10,000 in smaller businesses to make a more strategic investment, because he'd be dealing with lesser numbers and there's a greater potential that anything would be missed in that sector. He would probably concentrate on smaller businesses. Additionally, according to Buffett, investors should act vigorously when they come across a solid investment opportunity and trust their own judgment when selecting the company to invest in. Buffett buys shares of excellent companies that are trading below their real values and holds those investments for as long as the companies continue to be excellent. The S&P 500. Buffett once recommended the S&P 500 Index Fund. All or most of the equities in this widely used S&P 500 index are held by an S&P 500 Index Fund. According to its own description, the index represents leading businesses in leading industries. Strict standards for market capitalization, liquidity, and profitability must be met by these top stocks. Although each stock in the index can be purchased separately, Buffett advises that it is far simpler to invest in an S&P 500 Index Fund. There are numerous S&P 500 index funds on the market. If you want to follow Buffett's recommendations, a low-cost fund or a fund with a low expense ratio is your best choice. The expense ratio for Vanguard S&P 500 ETF, for instance, is 0.03%. In other words, for every $10,000 you invest, you pay $3 annually. To be clear, you do not directly pay this sum. There's no line item on your statement. The returns from the fund includes those expenses. Several dollars a year may not seem like much, but over time, fund expenses will affect your bottom line. Consider that you want to put $10,000 per year into an index fund for 20 years. The estimated future value of your investment is $405,506 if you select the Vanguard fund with an expense ratio of 0.03%. After inflation, that implies a market average growth rate of 7% annually. The Rydix S&P 500 fund, which has a much higher cost ratio of 2.31%, is another option for investing the same sum. Approximately $85,000 less, or $320,030 is your estimated balance after 20 years. In addition to the low-cost suggestion, Buffett's advice also includes the imperative directive to constantly invest. Regardless of what the market is doing, you should always invest what you can each month. Investing consistently can be simpler and more successful than timing your trades. It's simpler because there are fewer decisions to be made and no need to worry about the direction the market may take tomorrow or next week, as compared to trading exclusively when the market is strong. It also increases your gain potential by resulting in, on average, a reduced cost basis. A simple solution to the difficult issue of wealth creation is a recurring investment in a low-fee S&P 500 index fund. You could double your money every 10 years at that rate of return. What is Buffett's investment philosophy? Buffett adheres to the value investing tenets of Benjamin Graham. Value investors seek out securities and unreasonably low prices relative to their inherent value. While there isn't a single well-accepted method for figuring out intrinsic value, it's typically calculated by looking at a company's fundamentals. The value investor, like bargain hunters, looks for stocks that are undervalued by the market or that have value that isn't widely acknowledgeable by other buyers. This value investment strategy is elevated by Buffett. The efficient market hypothesis is rejected by many value investors. According to this hypothesis, shares of stock always trade at their fair value, making it more difficult for investors to purchase inexpensive shares or stock or to sell them for higher prices. They do have faith in the market's eventual turn toward those high-quality stocks that were once undervalued. The value of investing in oneself as a means of success has been emphasized by Warren Buffett time and time again. Making wise financial decisions and learning more about the activities you want to engage in are part of this. He considers every firm as a whole, so he only selects stocks based on the potential of the company as a whole. Buffett holds these equities as long-term investments because he prefers to own high-quality businesses that have a strong track record of producing profits rather than pursue capital gains. Buffett doesn't worry about whether the market will one day recognize a company's value when he invests in it. He's worried about the business viability of the corporation. When analyzing the correlation between an investment's level of excellence and price, Warren Buffett looks for low price value and uses it in his 7-step investment process. Number 1. Performance of the company. The term stockholders' return on investment is occasionally used to refer to return on equity. It displays the amount of income owners receive from their shares. Buffett always looks at return on equity to determine whether a company has consistently outperformed other businesses in the same sector. Return on equity equals net income divided by shareholders' equity. Looking at the return on equity in just the last year isn't enough. The investor should view the return on equity from the past 5 to 10 years to analyze historical performance. Number 2. Debt. Another important factor that Buffett carefully evaluates is the debt-to-equity ratio. In order to produce earnings growth from owners' equity rather than from borrowed funds, Buffett desires to see a minimal amount of debt. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. The greater the ratio, the more debt is being used to finance the company's operation rather than equity. This ratio demonstrates the ratio of equity and debt the company utilizes to finance its assets. Variable income and high interest costs might be caused by a high debt-to-equity ratio. Investors occasionally replace the overall liabilities in the formula above with only long-term debt for a stricter test. Number 3. Profit margins. In order for a company to be profitable, its profit margin must both be healthy and steadily growing. Profit margin equals net income divided by net sales. Investors should look back at least 5 years to get a fair idea of historical profit margins. Increased margins signify management has been exceptionally effective and successful at keeping costs under control, while high profit margins show that the company is running its operations successfully. Number 4. Value investing. Only businesses with a minimum 10-year existence are normally taken into consideration by Buffett. The majority of technological companies that have gone public in the last 10 years wouldn't therefore appear on Buffett's radar. He only invests in a business that is completely known because he doesn't comprehend the workings of many of today's technology companies. Finding companies that have endured through the years but are still undervalued is necessary for value investing. Value investing concentrates on a company's financial performance as opposed to technical investing, which examines a stock price, volume, and past price movement. Never undervalue the importance of past results. The ability or lack thereof of the corporation to raise shareholder value is shown by this. However, keep in mind that a stock's previous success does not guarantee future results. Identifying the company's future potential is the responsibility of the value investor. This is a difficult question to answer. Buffett, however, obviously excels at it. Number 5. Commodity reliance. Buffett likes to avoid businesses that produce identical goods to those of rivals and those that depend only on a commodity like oil and gas. He believes there's not much that differentiates a company from another one operating in the same sector if it does not offer anything unique. Buffett refers to a company economic moat or competitive advantage as any feature that is challenging to imitate. It's harder for a rival to obtain market share the broader the moat is. Number 6. What's the value? Finding businesses that fit the other 5 requirements is one thing, but the most challenging aspect of value investing is figuring out whether they are undervalued. An investor must ascertain a company's intrinsic worth by scrutinizing a variety of business metrics, such as earnings, revenues, and assets in order to verify this. Additionally, a firm's intrinsic value, or what a corporation would be worth if it were divided up and sold today, is typically higher than its liquidation value. Intangibles like the value of a brand name, which isn't expressly included in its financial accounts, are excluded from the liquidation value. Buffett compares the company's present market capitalization, its current entire worth or price, to its intrinsic value after determining the company's whole market value.